Hey, this is Sasha. Thanks for joining me here for another video. Today, what I want to do is share with you how to read an options table. Now, I have a couple more of these videos out. So if you still get stuck, you still are unsure, feel free to check out these other videos right here. And that way you can get some more insight and deepen your learning and education. And of course, be sure to check out our website as well at tradersfly.com. That way you can check out also some of the great products, courses, and things on option trading if you really want to get some detailed knowledge and information. Anyways, with that being said, let's get started. I want to share with you some thoughts and ideas and concepts all about the options table, how to read it and dissect it so that way you don't get too confused. All right, let's get started and get going. All right, so I'm going to try to make this video as simple and as quick as possible for you. Usually when you look at options, there's going to be this table like this. Now, before you even get there, there's going to be like on this side, or under it, you'll have stock price. You might have the bid, ask, volume, those kinds of things. That's kind of level one quotes. Then you get this calls and puts kind of stuff that comes up. Now, if you don't know what calls or puts are, in general, a put allows you to put that stock to someone else. So you're kind of putting it. So let's say the stock tanks, you could go ahead and put it to someone else. That's if you're a buyer of puts. And if you're a buyer of calls, it allows you to get that stock at a lower price. So let's say you get a call at $130 and a stock explodes to like $180. Well, if you have that at 130, that means, hey, I have the right to get that stock at 130. That's my contract, that's my coupon code, and that's what I'm capable of. So I'm gonna go ahead and do that. Now, in either case, you can be there's four parts of the trade. You could be a buyer or a seller of the calls, or you could be a buyer or seller of the puts. So there's four parts to these kinds of trades that you could be on. So it really just comes down to where you want to be. For our example, we're just going to take a look at buying because that's the easiest approach. So normally when you're looking at the call side right here or the put side, you'll have dates and strike prices. So you might have here, let's say a stock's going at 200. This is kind of the middle strike price. This is where you want to trade at. So for example, hey, I want to be, I'm okay owning that stock at 200, or I want protection of that stock at 200. So these are your strike prices. So it'll be like 200, and then they start going kind of down. This way, 195, 190, 185, 180, and so on. And this will be kind of 205 this way, 210, 215, 220, and so on. So they kind of go up this way, go down that way, and then you have this table. Let's say the current price is 200. You have in the money, out of the money, and at the money. So at the money, this would be kind of at the money on the put side. This right here, okay, you have, this is out of the money, and in our put side, this is out of the money. In the put side, this is in the money. And in the call side, this is in the money. So what does that really mean? What do all these things mean? Out of the money means there's no like big value to it, right? The price hasn't hit there. So if you're dealing with calls, well, if the stock price is already like at 200, well, if you had something at 180, let's say you bought it a few months back, hey, man, that stock is at 200, you got it at 180, you got a coupon code, so that means you can actually use it and it's worth something. If you have a coupon code at like 220, well, it's not really worth anything, so it's out of the money. It's not really worth anything like physical. It's not like real. It does have time value and other things be attached to it, but it doesn't have that stock value. On the put side, what you have is a similar concept. Out of the money, well, that stock's not below 180, right? Let's say you have a put at 190. I can put that stock to someone at 190, but it's not at 190 or lower. It's at 200. So these are out of the money. They're not worth anything. But hey, you bought some protection a while back when that stock was, let's say, at $330, and you bought a put at 220 and now it's at 200. Well, hey, if that stock's at 200, this is in the money, so it's worth something. And now all of a sudden, hey, that you could put it to someone at 220. So that's why these are kind of backwards, okay? Just because the puts allows you to put something to someone else, the calls allow you to buy that stock at a lower price. Now, in most instances, which you'll have also in this case, we're looking at kind of a 1 month time frame here. So this could be, I'll make it a little bit bigger for you. This might be, let's say, the March time frame. Okay. Now you have the same table, and it'll go into April, May, June, July. So this could be like 20 days. This one might be, let's say, 50 days, and so on. So they have different days, and you could say, hey, well, I want to get a put or a call 20 days out, or I want it 50 days out, or 100 days out. So that's kind of how it works on the basic sense. Now, what I want to do is share with you on the trading platform how this all works. But if you're really serious about this kind of stuff, definitely check out the Options Mastery Foundation course right here on our website. You're going to get a lot more knowledge and insight beyond the scope of these mini YouTube videos. So anyways, with that in mind, let's check this out here on the trade panel. So here's the table. And when you look at this, you'll see here's kind of our panel right here. So what we have is, here's the basic option, or the basic quote. Here you have the ticker symbol, and here's all your prices right here, last, net, change. So that's basic stock stuff, right? So the current price we know is at 145. So as I look at this, and I look at my options chain right here, these are all the options chains stuff. So you can see right there, it says option chain. You can see I got November's, and here's the days remaining, days until 2 days, 9 days. This one's 16 days. This is December 6th. This is 30 days. So you could see they go, hey, if you want to go 800 days out, you could do that with the January 21st of the year 2022. And you could get those contracts as well. Now it's more expensive, you go further out in time, but you could go that far if you want. So again, if you buy more time premium, right, a longer coupon, it's going to cost you more. So anyways, what you're doing here is now, okay, let's say I want to open up this 65 days to go, or 100, 180 days to go. Let's say I want to go in this route, and you'll see here in the center, what you have is those strike prices and that expiration date. Now I could change those strike prices to be only like 10 of them. So you only see 10 of them. I could, show 5 of them. And it's doing the 5 that are based on kind of at the money. And at the money right here is that 145, because the current price is 145. Now here we have our calls. How do I know? And here we have our puts. How do I know? Well, it says right there, there's our puts, and here's our calls, right? Puts and calls. So if I open it up, let's say 10 strike prices. Now what I can see is this highlighting effect here, and it's a little bit purple on this trade panel. Sometimes they do it differently. These are all in the money, and out of the money, let's make it orange. These are all out of the money. So those are out of the money. So that's kind of, you can see what's happening here is that the purple is actually, it's more worthwhile because you can do something with the stock itself. So what you can do is now, if you're looking to choose a contract, you could say, hey, well, I'm interested in a call contract. I could get it at 165. Well, I'll go ahead and do that and say, hey, I want to get a 165. I'm okay with owning the stock if it goes above 165. Well, why would you do that? Well, I think we might have a pullback, but if we actually do start heading higher, I'm okay to own it at 165. You could go ahead and get a contract there. I could just go ahead and right click it, buy a single, boom, and analyze the trade, and you can see what this contract will look like. Now, most people, they just deal with the contracts. They don't usually get the stock itself. What happens is this contract becomes more valuable because now you could sell that contract to someone else who actually wants the stock. So it just becomes more valuable. You just sell that contract for a little bit more money, and then you just capitalize on the difference, right? It's like buying a phone for $200 and selling it for $220 because all of a sudden it becomes more rare, worthwhile, whatever, people want it. So here you buy this contract for $375, and if it does go up in price, let's say to $160, and you could go ahead and cash out with about $500 in profit if that happened right away. Otherwise, you do lose some premium every day. That's that theta decay right here, negative $2 a day for just holding that contract because you're a buyer. And of course, you could be a seller of this contract. So just to show you, you could do the opposite of that. You could be a seller. And if you're interested in puts, it's no different. So I could say, okay, well, I'm interested in getting a put at 130 or 140 because I have a stock. If you got stock and you're worried about a big down move, a bomb, explosion, war, crazy presidents, whatever, what you could do is go ahead and say, okay, well, current stock price is 145. You know, I've made some money on it. So what I could do is say, I want to protect that stock at 140. And I could go ahead, right click, buy that. I want to go 184 days out. I could just do 65 days out if I want, but 184 days, I'm worried about the next 6 months or so. So I could buy the protection. If I go 135, it'll cost me less. If I go 130, it'll cost me even less. So I'll go ahead, buy a single, analyze the stock, and you can see that kind of gives me a downward direction bias. Now, most people do this when they have stock. So let's say we buy some stock, analyze that position. So normally your stock position here, as you look at this chart and graph, here are the stock price. So here's our 140 level. Stock goes up, you make money, right? And here's our money or profits. So as we go up, we make, you know, 8,000, 9,000, 10,000, and so on. As we go down, we lose money, da 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 da. So as you zoom in on this, what you could do is say, I want to protect that stock. Well, I got 5 contracts because I have 500 shares. One contract protects 100 shares. So I would do is add this in, and all of a sudden it flattens my curve on the downside. So if that stock goes to 100, if it goes to 0, my loss would only be, let's say, $10,515. Still sounds like a lot at a $50 price point. But without it, at $50, I would be down almost $48,000. Because remember, 500 shares of Caterpillar right now is pretty costly because you're paying $145 a share. So anyways, that's really the point of the puts, is to protect yourself. And again, you could go a little tighter and go 135s, and then you lose a little less, $8,000 maybe. But it wouldn't be a ton more if that stock continues to tank, because hey, if you still believe in the stock, you just want to protect it, maybe downward move, whatever. That's kind of a nice approach. So anyways, that's how you read a basic options kind of table. There's also different kinds of things here on the columns. You could change these from right now I have probability in the money and open interest, but you could go ahead and change it to, hey, volume. You could change it to option codes. So hey, if you want to see the option codes, you could do that. You could go ahead and change it to the deltas. Some people like seeing it that way. So all those things, up to you. You could modify these a lot of times how you want. You could open up the strike prices to, like, let's say 900 and see all the strike prices. This one doesn't have as many, but if you look at something like Amazon, what you'll see is if we open up 900 strikes, well, you can see there's a lot of strikes and a lot of strikes that way. So just because it's a larger dollar value stock. Anyways, that's the basics. There's also some more advanced stuff to looking at some filters. So if you want to filter some stuff, in this case, what you could do is create a filter, and there's some filters, days to expiration. You could also change it to spreads. Like if you're dealing with spreads, this becomes more complicated, like calendar spread, and you can see kind of the layout starts changing. You could see straddles and diagonals, covered stock. So there's a lot of different things you could do. But I just kind of leave it as single, and then what I'll normally do is just kind of right click and either buy or sell. And in this case, you could do, hey, I want to buy a straddle, or I want to buy a vertical, or a back ratio, or a calendar, or butterfly, whatever your heart desires. So anyways, that's the basics behind this options table. There's not much more you need to really know about it on the basic side. With time, and the more you use it, you'll get more familiar with it, and you'll see there's other things like statistics and that kind of stuff. Sometimes I'll glance over those things, but probably you'll just kind of hang out in these contracts as you get more familiar with them. You'll tweak it based on your personal needs, but definitely check out our website here in the options foundation, or verticals and diagonals and butterflies coming soon even, to learn a lot more about option trading. All right, thanks for joining me. Remember to hit the subscribe button here on YouTube, or of course, join the newsletter list by clicking the link over here. That way you get up to date on any new courses, products, books, free videos, trainings, webinars, classes that we have coming out. Thanks again, and I will see you next time.